Good afternoon, everyone. Welcome to the 2021 year-end tax planning webinar. We're going to go through a few of my favorite year-end planning tips. And just as a little bit of housekeeping, you should all have the opportunity to post any questions there, and I'll try to get through them all at the end. Definitely, the idea is that we're dropping in a few nuggets of things that you can implement before the end of the year. So that gives you about 3 weeks to do some fun planning and try to move the tax needle. That's pretty much the idea with year-end tax planning. So let's get started. So just as a little bit of a disclosure, these are meant to be generic tax planning tips. Of course, before you go ahead and implement any of the items we'll be reviewing today, I strongly suggest you speak with your financial planner or your CPA. There'll be recommendations or ideas as far as Roth conversions or gain harvesting. These are things that if you haven't thought them through, can have significant tax implications. So just be sure to speak with your CPA or your financial planner before implementing any of the items we'll be reviewing today. All right, so a little bit about me. My name is Marianella Collado. I am the CEO and Senior Wealth Advisor here at Tobias Financial Advisors. I am a CPA and a Certified Financial Planner. So spent many years just strategizing and working on complex income tax and estate and gift tax strategies for high net worth individuals. So definitely this is your opportunity to ask questions that you've considered or had, want a little bit more insight on. So I welcome those questions, and you can always call our office if you want to just pick our brain on different strategies. So why do we do year-end tax planning? It's my favorite time of the year. 'Tis the season. The idea is that you're thinking about tax planning, not just looking at 1 year, but you're thinking about tax planning across multiple years. And the reason that that's so important is because you have to consider what tax bracket you're in today versus tax brackets in the future. And I also like to pair this with projections, financial projections. So it's great, maybe you can accelerate some income because you're in a lower tax bracket this year as opposed to what you project you will be next year. But that doesn't mean that necessarily makes sense. And this is why we like to pair year-end tax planning with financial modeling so that we can look at the impact of prepaying a tax, even if it is at a lower rate over the course of not just 1 or 2 years, but 10, 15, or even 20 years. So that's the important, is pairing year-end tax planning with financial modeling. So why is this so complicated? Well, it's not as simple as just saying a Roth conversion is a great idea. Well, we need to look at the grand scheme of things. Why are we implementing a Roth conversion? What are the long-term savings associated with that Roth conversion? How does that affect me now? And who will benefit? Will I benefit from it during my lifetime, or will this be for my children? So it's not as simple as just saying, a Roth is a great idea, I'm just going to implement it. You have to pair it with the goals and objectives that you have personally. So this is why it's not as simple as just, knowing that it's a good idea and implementing it, but thinking through how it works and why we're doing it. So the idea is that we're thinking about the timing to recognize income or recognize gain, and then we're thinking about the timing to take certain deductions, accelerate them versus defer them, and the impact that that has on our marginal tax bracket. And this gets a little bit more complicated when you throw in pending legislation, and that's always fun. And for us, it seems like there's always something. So year-end always becomes a crunch because there's so much uncertainty around what tax laws will look like next year or the following year. So let's talk a little bit about that. So I do have some good news, kind of reviewing the Build Back Better Act, which is something that we've been talking about for a little while. And at first we were really panicking. over the idea that they were going to just, scratch everything that we basically do for our clients, from limiting Roth conversions, from reducing the estate tax exemption or accelerating the sunset of the high exemption levels, just anything under the sun. Everything we did in terms of planning, that basically was on the chopping block. The good news is that a lot of those things were eliminated. The other item that most of my clients were really concerned about was taxing capital gains at 39.6 for folks who had income of $1 million or more. So a lot of people who were thinking about selling their business or were going to trigger a gain, they were accelerating just because of the uncertainty of whether this was going to actually be implemented or not. That's all off the chopping block. The only things that we're keeping an eye on is they're looking to implement a surcharge for folks who have income in excess of $10 million. And then they're also looking to implement a limit on how large of an IRA you're allowed to have. And once you exceed those limits, they're going to have forced distributions. And the other thing that affects a lot of my clients, especially those who live in states with an income tax, is the cap on state and local income tax. They were looking to raise that from what is now 10 to 80,000. And I know that's been a bit of an issue, and a lot of states have actually created their own workaround to help residents at least get some benefit for the state income taxes they pay. The other thing that I'm really keeping an eye on, because this can affect a lot of you, is the 3.8% net investment income tax on active businesses. If you all remember, part of the Affordable Care Act, which included this, healthcare for all, that was going to be funded via 3.8% net investment income tax on investments and passive income. So it only applied if you had, say, rental property or an investment that you did not actively participate. It would be subjected to a 3.8% net investment income tax if your total income exceeded 200 or 250,000. Well, they're looking to expand that and actually apply it to active businesses. So that's something that I'm keeping a very close eye on. But these are the only provisions that pretty much remained as part of the Build Back Better plan. It still has not been signed into law, so we're going to keep an eye on that for you all. All right, let's start with tip number one. These are low-hanging fruits. These are things that we can do and just magically reduce our taxable income. So maximizing contributions to 401ks and IRAs. And sometimes, it's thinking outside of the box. If you have a portfolio, you have assets readily available to you, and then you can then reduce your taxable income by deferring and contributing more to your 401k. Even if you have to replace that cash flow from the portfolio, it's still a better strategy because you're reducing your total income. And this was a conversation I just had with a client the other day. I said, well, it looks like we weren't maximizing or trying to maximize from the beginning of the year. So let's take the next, and this was like beginning of November, let's take the next 8 weeks and make sure that we're contributing our entire net pay after Social Security and Medicare tax. And that difference that the client would have as cash flow to pay their bills or do whatever, we replaced it from distributions from the portfolio just to be able to reduce their taxable income. So it's just thinking about creative ways to reduce your taxable income and keep your adjusted gross income as low as possible. Another thing that just hurts when I see it is when people don't even contribute, and then that means they're leaving the match on the table. So at the very least, you have to consider contributing an amount that's going to get matched by the employer. You also want to look at the opportunity to fund IRAs and Roth IRAs. Anyone, and I'm going to repeat, anyone who has earned income is eligible to make an IRA contribution. Now, for a traditional IRA, it may not be deductible, But therein goes our light bulb goes off, because the opportunity is get the funds into an IRA, even if you cannot take the deduction, and then consider in the future doing a Roth conversion. And this is what's known as the backdoor Roth IRA. Sounds like a very painful medical procedure, but it's not. It's very simple. And as long as you're documenting that contribution and letting your CPA know that you've made a contribution into an IRA, they will then report to the IRS whether it's deductible or not, and then you can do the Roth conversion at no cost to you, because essentially it's all basis. And if you need a little bit more of an explanation on that, please call us. It's probably one of our favorite planning tools that we use here all the time. And then for those who are 50 years old, just remember that you're also eligible for the catch-up for an IRA. That's $1,000 more. So instead of just the 6,000, you can do 7. And then for 401ks, instead of just the 19,500, you can add another 6,500. And just note that for 2022, that maximum is going to go to 20,500. So if you want to start the year right, go ahead and change those elections to increase the contribution amount to 20,500 for the entire year. So Roth conversions, again, one of our favorite tools. This is just the idea of taking pre-tax dollars inside an IRA and converting it to a Roth IRA. And what you're doing by doing that is you're basically eliminating or removing your silent partner. Yes, you all have a silent partner in your traditional IRA. So the idea is that when you do these Roth conversions, you're doing them in a year that you're paying very little tax because it's an off year. Maybe you had losses from a business, you're in a much lower bracket than you'll ever be. So the idea is that you try to do these Roth conversions in those years where you're going to pay as little tax as possible. And even if that's not the case, I think it's always worth reviewing and analyzing what the impact is over the long term. So modeling out the impact of prepaying a tax today for the benefit of having future growth inside a tax-free account. And sometimes when we model these things out, we find that maybe the client never actually breaks even during their lifetime. And they might be okay with it because they're looking at it as a benefit for next generation. And the reason why this has become so popular is because as part of the Secure Act in 2019, just completely overshadowed by COVID, the Secure Act did something very terrible to all of our planning strategies. Because historically, we just thought it was a great idea, pump as much money as we can inside a 401k, a traditional IRA, and then when our kids or our grandchildren inherit those retirement accounts, they get to take distributions over their lifetimes. And of course, they're much younger than we are. The problem is that the Secure Act changed that. They literally pulled the rug from under us and said no more. So these accounts were meant to be used for retirement purposes, not for wealth transfer and generations and stretching it over multiple generations. So the only preferential beneficiary of an IRA or a 401k is going to be your spouse. They will be able to pretty much continue to take distributions over their remaining lifetime, and a few other different classes of beneficiaries, but that could be a whole presentation in itself, so we'll cover that at another time. Otherwise, if your children or grandchildren are the beneficiaries of these retirement accounts, they have to withdraw the balance within 10 years. So if you're thinking about an IRA with 500,000 or $1 million or 2 million, they have to take this out over the course of 10 years. It could be 1/10 every year for 10 years. It could be all upfront or all at year 10. So it's going to be less of an impact for them if what they're receiving is a Roth IRA, which is going to be tax-free, versus a traditional IRA, which would be taxable to them. And imagine if they live in states like New York and California, now not only are they having to accelerate the income recognition, but also pay state income tax on those distributions. So the idea is that you're evaluating whether this makes sense. Another example is I had a client say, well, my CPA said I should just do Roth conversions. And I said, okay, tell me a little bit more. Let's look at your whole estate plan. Where is all this going? She said, well, I have no kids and I'm not married, so it'll all go to my niece. And, I don't really care how much tax they pay, and most of it is going to charity. And so then the question was, well, then why are we doing Roth conversions, right? So I think, you can't look at an income tax strategy in a vacuum. I think you have to look at it holistically and pair that with your estate plan as well, believe it or not, because you don't want to just accelerate income just for the sake of accelerating income. You want to look at how this fits into your overall plan. Bunching. I love using donor advised funds. So let's talk a little bit about bunching. And the reason why this is so important is because, as you may all realize, our standard deductions were doubled as part of the Tax Cuts and Jobs Act. So if you were deducting $12,000 as a standard deduction, a couple is now at $26,000, $27,000. So what that means is that, to the extent you're making maybe charitable contributions at the same levels that you've always done. However, because the standard deduction is so much higher, you're now never crossing over the point of your standard deduction. So if you're donating $5,000 every year, it just doesn't even go over the standard deduction. So the idea is that we look to bunch them all. So we say, well, how much do you typically give in a given year? Is that 5,000? Okay, well, let's take donations for the next 5 or even 10 years. Let's do them all right now using a donor advised fund, which I also like to call my charity parking spot. So we donate all of the amounts that you would have donated or would be donating over the course of 5 or 10 years, and we contribute it to a donor advised fund. And then you lock in the deduction today. You're gonna get a higher charitable deduction. So this will take you over the standard deduction, right? We're going over the standard deduction. So you're guaranteeing an income tax deduction for those donations instead of giving small amounts every year that never get you over that hurdle. Then, where we kind of add a little bit of a cherry on top is, in order to fund those contributions for the next 5 or 10 years, we look for appreciated securities. So we find whatever is in your taxable account that has had the largest appreciation, and that's what we look to contribute to your donor advised fund, because what that does is that also eliminates the capital gain, the unrealized capital gain on those securities. So rather than using cash, we use the appreciated securities, and then you can turn around the very same day and repurchase. So we have a client that he loves Facebook, and he has some Facebook in his little Play account. And so that's really run up over the past years. So every time he wants to fund his donor advised fund, we donate the Facebook, and then he turns around and the cash he would have otherwise donated to these organizations, he pretty much repurchases the Facebook stock. So in effect, he's given himself a free step up in basis. So that's actually, we will go into it a little bit more in the next slide, but that's how I like to make sure we take advantage of donor advised fund to be able to lock in an income tax deduction. All right, well, donating appreciated securities. So let's go through the mechanics. I kind of touched on it. So yes, if you donate cash, you will get the deduction, assuming you've crossed over the standard deduction hurdle. But a better way to look at this is you can also donate long-term appreciated securities. This could be an individual stock. This could be a fund, an exchange traded fund. It has to be held for a year, so it has to be long-term. It can't be short-term. And then when you donate the stock to the charity, you're going to deduct the fair market value. So in this example, let's say that you have stock and it cost you $20,000 to buy the stock, and the current price of the stock is $50,000. So in this case, if you had to sell the stock to be able to make a cash donation, you would have to pay capital gains of $7,140, including that net investment income tax we talked about earlier. So if you sell the stock for 50 with a basis of 30, you have capital gains of, 50,000 with a basis of 20. You have capital gains of 30,000, which is going to generate a tax of 7,140. This is going to give you a net of 42,000. So this is what you would, in the scenario of selling the stock and then donating the proceeds, you would get a deduction of 42,860. So the income tax savings, in effect, is just the tax benefit on the net cash. Whereas if you take the securities, so we don't sell it, we just transfer the securities directly to either the donor advised fund or directly to the charitable organization, we don't have any gain to recognize. You get the full deduction for 50,000, and now the benefit is not only the income tax benefit on the actual value of the stock, but the capital gains that you avoided. So it's actually greater than 18,500 because not only are you deducting the 50, but you're not paying the 7,140. So it'll really cost you cents on the dollar by using appreciated securities. And again, I look at this as an opportunity to give yourself a free step up in basis. And I get this question a lot. Is there a wash sale type rule when it comes to repurchasing the securities that you just donated? And the answer is no. You can donate and that same day repurchase those securities. There's no wash sale type rule with regards to donation, or no wash sale type rules when you trigger gains. And we'll talk a little bit more about that. Okay. Well, perfect segue, loss and gain harvesting. So this is such an important part of planning because I often say that in wealth building and in financial planning and investments, it's not just about what you make. More importantly, it's what you keep. And how can you make sure that you're planning proactively to pay as little tax as possible? There's nothing wrong with that as long as we're doing it within the confines of the tax laws, right? So a very, very incredible and powerful opportunity is loss harvesting. And so I joke sometimes, I say, you know, when the market takes a little bit of a downturn, I know I shouldn't say that and you probably think I'm nuts. So the idea is that when the market takes a little bit of a downturn, which is normal, it gives us the opportunity to really help you save on your taxes. So we take advantage of that. These are the tax gods giving us an opportunity to bank losses. So during COVID, as an example, we went crazy banking all the losses we can find so that in the future, when we have to rebalance portfolios or we need to raise cash for monthly distributions or whatever we need to do in the portfolio, or you know, we have funds that are kicking off capital gains, we've harvested all of these losses to offset this income in the future. And it's such a powerful tool. So the idea is, so let's go through two scenarios, one scenario without loss harvesting and one scenario with loss harvesting. So what you do is you look to sell the stock at a time that it's gone down in value. Now, when we do that, we don't just sit with cash because we don't want the tax tail to wag the dog. So the economics of it is more important than just the tax planning, meaning that you don't want to bank the losses and then sit with cash and all of a sudden that sector in the market has experienced a run up. That would offset the benefit of harvesting those losses. So the idea is that we're banking the losses and we're looking to go back into the market in something that isn't substantially similar. And that's the way the IRS defines the wash sale rules, is you can't take a loss and then reinvest in the same stock or the same fund or anything that's substantially similar. So there is some technicality behind loss harvesting. But the benefits of loss harvesting here, for example, is paying $200 more, in my $2,500 example. So if anyone has any questions on how it works, it's just taking advantage of temporary market dips to help us save on taxes going forward. Okay, health savings account. These are known as the triple crown of savings account. Why? Because not only do you get the tax deduction on the way in, right? So you get to deduct contributions into the health savings account. They grow tax deferred. And then to the extent that you take distributions from the health savings account to cover medical expenses, they're basically tax free. Triple crown. So deduction on the way in, tax deferred growth, and then tax free distributions. Just a couple of things to note. You're only eligible to contribute to a health savings account if you have an HSA eligible health insurance plan. So just be careful. These are high deductible health insurance plan, but just because it's a high deductible health insurance plan doesn't necessarily mean that it's HSA eligible. So just make sure that you confirm with your provider to see if your plan is an HSA eligible plan. And as long as you haven't hit Medicare age, you're allowed to contribute $3,600 for a single plan or $7,200 for a family. Another important thing that most people don't realize is that once you are 55 years old, you're allowed to do a catch-up contribution, but that also applies to your spouse. So let's say you have the family plan and it's through work, you're allowed to do the $7,200 plus the catch-up, but you and your wife are 56. She can also do the catch-up, and she would just have to open up her own HSA, another platform, and then do her own $1,000 catch-up. It's just a really powerful savings tool. But one note here, this is all well and good, but the idea behind or getting the most use of your HSA is that you don't use it. If you can afford to pay your medical expenses out of pocket, just keep this account growing. But you want to make sure you invest it. So you can set up an investment account and pretty much invest the assets inside the health savings account. And you want to put assets in there that are going to experience the highest growth. So typically we'll look to do either small cap or emerging markets inside the health savings account, just because that's the asset class that has the highest potential growth. Okay, this is the time for to run year-end projections and get a sense of what's happened throughout the course of the year. Do we need to make a fourth quarter payment? Did we have sufficient withholding? Is there anything we can do to eliminate or reduce underpayment penalties? This is the opportunity. These things cannot get done once you're in January or after you prepare the return and then you realize, yikes, I should have made a fourth quarter payment. Year-end tax planning has to happen at year-end. So once you're running those projections, you may discover that your income is a lot higher than you anticipated. So one trick to try to reduce any underpayment penalties is to increase your withholding. So again, we have 3 weeks left. If you discover that you've underpaid for whatever reason, but you didn't just underpay in the fourth quarter, that you underpaid throughout the year because a bonus kicked in, you had income from the portfolio that was a lot higher than you anticipated, you can increase your withholding for the next few pay periods. And the beautiful thing about withholding is that it can happen on December 31st and still count as if it was paid throughout the year. So it really is a powerful tool. We take advantage of this for those folks who have IRAs and they have to take required minimum distributions. In fact, we don't even pay any quarterly payments for those folks. We basically true up all of the payments they should have made with the final required minimum distribution at year end. So we take care of it all in December and it counts as if it was paid pro rata throughout the year. So it's a really powerful tool. Again, you won't know if you don't run projections, so I recommend running some projections just to see what the year is looking like. While we're on the topic of required minimum distributions, this is a powerful, another powerful strategy is qualified charitable distributions. You are able to fulfill your required minimum distribution by transferring funds directly from your IRA to the charitable organization. What that allows you to do is to essentially get an above the line deduction, meaning you don't have to pick up that distribution from the IRA as income. That transferred to the charity fulfills your required minimum distribution, and it's basically an above the line deduction. A couple of things, just be careful if you're doing these qualified charitable distributions. You will notice that when you get the 1099 from the institution, there is no indication that you did a QCD. So you need to make sure you keep track of it so that you can let your CPA know. But more importantly, you need to make sure that you have an acknowledgement letter from the charitable organization, because if you're audited and you don't have an acknowledgement letter from the organization dated before you file the return, the IRS can disallow the deduction. So we don't want that. Another thing to note while we're talking about charitable deductions, the CARES Act allows for a $600 charitable deduction for folks who are taking the standard deduction. It's not exactly an above the line deduction, but it's an additional itemized deduction, or an addition to the standard is probably a better way to say it. Okay, so if you're self-employed or you have some sort of consulting income, there is a major opportunity to really shelter a lot of that income using solo 401ks or SEP IRAs or even simple IRAs. The benefits are tremendous. And then depending on the level of income, depending on your age, and depending on how much you're comfortable putting into these tax deferred accounts, you can even pair that with defined benefit plans. I mean, it's a tremendous opportunity to reduce your taxable income, maybe while you're in a higher bracket, so that later on we can take those distributions while we're in lower brackets. So something to consider. If you're self-employed, you should definitely make sure you're running projections, or if you're receiving consulting income, if you're on the board of any corporation that pays you a consulting fee, that's an opportunity there. Wealth transfer. This has been the hot topic. It's had every estate planner in town going nuts, creating and funding trust. But as I mentioned earlier, the good news is that this is off the table. So we don't expect that the exemptions will drop until 2026 as originally scheduled under the Tax Cuts and Jobs Act. So you will see that for 2021, the exemption is $11,700, $11,700,000 per person, and that's gone up to $12,060,000 per person. The tax rate is 40%, and the only thing that's changing for next year is the annual exclusion is going up from 15,000 to 16,000. So in order for you to determine whether you should be making any moves here, we need to do a few things. Number one is get a good handle on your total assets to see if we're running the risk of having a taxable estate. And you have to do this proactively, right? We know 2026 is around the corner, and we know that in 2026, the exemptions will be dropping from the now 12 million that will be for 2022, all the way down to the pre-Tax Cuts and Jobs Act exemption level, which was 5 million, but it will be adjusted for inflation. So we expect that everyone will be around 6.5. But you want to start planning now. And what are the things we can do to reduce your taxable estate? Maybe funding some trust, irrevocable trust, but we need to be careful because we don't want to do anything that can jeopardize your ability to meet your needs. So this is something we have to think through before we jump into this. We can pay for medical and education expenses for our children and grandchildren. Again, I would want to test that the projections are sound, because my priority is going to be to make sure that your needs are met before we start giving it away. And then front loading gifts to 529 plans. This I like, and the reason why I'm a big fan of 529 plans is because there are very few tools out there that allow us to remove assets from our estate, but should we need them back, be able to claw it back. And 529 plans provide a very nice opportunity to, again, remove assets from our estate, but be able to pull them back if we need 10 or 20 years down the line. And we can talk about the mechanics a little bit more. If you'd like, feel free to call me, one of my favorite topics. Life insurance, this is usually stepping stone number one when we expect that someone will have a taxable estate, but it all depends on the types of policies and the cost. And again, just kind of comparing what the impact will be if we have life insurance and we put them inside a trust versus just not buying the life insurance and dealing with the tax. There are also a bunch of other estate freeze strategies that are so powerful when we have a low interest rate environment. We've been talking to clients about either making low interest rate loans to their children or grandchildren, or funding grant to retain annuity trust. These are all really popular when rates are low. So if you're curious about that and you want to see that modeled out, give me a call, because again, we've been having these conversations ever since the proposals to reduce the estate tax, and everyone was really worried. All right, so for those who have stock options, they present an opportunity. So you want to make sure that you're reviewing your stock options, whether they've vested or not vested, and if they're incentive stock options versus non-qualified stock options. If they are incentive stock options, they usually have a pretty significant implication for the alternative minimum tax. It's a huge AMT adjustment. So typically what we like to do when someone is thrown deep into AMT, and AMT could be a subject all on its own and we can spend an hour on it, is that it gives you the opportunity to accelerate ordinary income, because when you're in AMT, you're paying a rate of 28%, which is much lower than the 37 or 39%. 37% is the current top rate now. But it gives you an opportunity to accelerate income and bring it in at 28%. So again, this is, if you have stock options, it's something that you need to be planning around that, looking at what is the strike price of those options and what's the impact now versus waiting to exercise them later on. Passive activity losses. So this relates to folks who have rental properties or who have investments in an entity that they don't materially participate. So if you invest in a real estate fund, it might have 1,000 other investors, that income is considered passive income to you. So a couple of things on passive income. Or if you own a real estate property outright, you own a single family home and you rent it, that income is passive income. Very few exceptions to be able to claim that you are an active real estate professional. So generally the rule is rental is passive by definition. And what that means is that if you have passive losses, you're not able to deduct that against other ordinary income. It won't reduce your wages, it won't reduce your investment income. So you basically bank them and you get to use them in years where you have passive income. However, something that we keep an eye on is if someone has significant passive loss carryovers, is this entity ever going to turn around? Is there an opportunity to dispose of this, take your losses as they are and free them all up? Because those passive losses are freed up in the year that you dispose of that investment. So we've had a few instances where we've discovered that there was a huge passive loss carryover. The client thought that that investment was never going to turn around. So we looked to be able to just sell it, even if it's for $1, and just take our losses and move on, because the tax benefit on the loss was much larger than waiting for the investment to turn around. Again, something that we should look at. And if you have large passive loss carryovers, just make sure, and this is something that we catch often, make sure that they're carrying over correctly. When we typically review tax returns, we find that sometimes they get dropped off. It could be like a software issue, but make sure that from year to year that those losses aren't being mistakenly dropped off the return, because they're valuable. And the higher the tax rates in the future, the more valuable those losses will be. So I think this might be our last tax planning tip. And this goes back to, that holistic view on tax planning. Tax planning, it's not just, loss harvesting and, Roth conversions. It's thinking about your overall investment strategy. This idea of making sure that you keep more of what you make. So, you look at asset diversification, which is a term that everyone is comfortable with, but rarely do people think about asset location. So what this allows you to do is to reposition your portfolio, to look at all your accounts on a holistic level. This big, throw all your accounts, and it's a big part of this pie. And think about what you're investing in and where those investments should be held. Right? We know that certain investments are going to kick off ordinary income, while other investments may kick off capital gains. So in order to take advantage of the characteristic of those investments and get the most efficient use out of them, is you want to try to place those assets that generate ordinary income in tax deferred accounts, like your traditional 401ks and traditional IRAs. Those should be the ones that hold the fixed income or corporate bonds, if you have some of those in your portfolio. And then all the other accounts, the taxable accounts, you may want to hold things that are going to kick off qualified dividends or long-term capital gains, because those items of income, you're going to pay tax at 15 or 20 or 23.8%, much lower than the 37 potential ordinary income tax rate. And then the Roth accounts, you want to put in those accounts those investments that are expected to have explosive growth. I don't know if you all saw that article on the gentleman with a $5 million Roth IRA. He's probably the reason why they're trying to attack the value inside retirement accounts. But anywho, the idea is that you're being really thoughtful about what assets you're placing in what account so that you can have a tax efficient return. It's very different if you have a 10% inefficient tax return, a tax investment return in your portfolio versus a 8% efficient return on your portfolio, right? This 10 could be more like 6 or 5, depending on the tax implications associated with it. So that pretty much covers what I was going to review. I will see if there are any questions here. Let me see. We can definitely share the presentation when we're done. I'll be sure to circulate a copy, and there will also be a recording which we can circulate. So if you ever want to go back and listen to it again, I probably spoke very quickly. This is what happens when you're from Queens, New York, speak quickly. So I can share a copy of the presentation and also a recording of the presentation. Any other questions? So I'm waiting to see if you all post in the chat. Question on cryptocurrency to adapt. That's become a popular question now. I'm on the board of Gilda's Club, and Gilda's Club was approached by a few folks looking to donate crypto to Gilda's Club, which is you know, I don't think there's anything precluding a donation of crypto as long as the charitable organization is willing to accept it. I'm not sure that a donor advised fund is going to accept crypto because those accounts are generally held at an institution. Like for us, the donor advised funds are held at TD Ameritrade or Charles Schwab. So I don't know if they're definitely not going to accept crypto. But maybe the charity directly might, if you call them and they're willing to set up a Bitcoin or a Coinbase account. I know that as part of the board, we said, well, we're okay accepting it, but we would not hold it because it's so volatile. But very good question. Let's see what else is here. All right, so it looks like I covered all the questions you all had. One thing I didn't mention during the loss harvesting is for those folks who have significant capital gains, you may want to consider qualified opportunity zone funds. You know, we're feeling a little bit more comfortable with those just because some big players are now creating them. I know when this first came out, we were worried that we were going to have Joe Schmo's qualified opportunity zone fund, and we weren't comfortable with the idea of, you know, investing in a fund to defer gain, but potentially losing your capital. So if you had a big gain event, we should talk about qualified opportunity zone funds just to see if that makes sense for you. Otherwise, that concludes my presentation. I hope you all got a nugget or two. And if you have any questions whatsoever, feel free to call us. We'd be happy to talk through some of the strategies. Otherwise, we're going to go back to year-end tax planning mode. I hope you all have a wonderful day, and we'll talk soon. Take care.